Thank you. Thanks for having me.
Good to have you back.
Thank y'all so much. It's so good to be here with y'all. And I did see a few hands, so that makes me excited that at least a few of you are excited about economics. I have to tell you, I wasn't excited about economics, but I learned how very important economics is and to understand where things are and where they're heading through the great financial crisis. And I'll tell you a little bit about that. But I learned after I lost a whole lot of money that I needed to be a student of the economy, not just a student of investing. And so I'm hopeful today that even if you don't love economics, I can tell you why understanding where the economy is and where things might be going will make or break you truly as a real estate investor, especially in periods of times where the economic cycle is shifting, because that's when people get surprised, when really the signs that tell you things are shifting start 2 to 3 years before they really shift. And so if you get nothing else out of this, I want you to take pictures, take notes on the key economic indicators that you should watch, because what you get from the media and the news is not the data you need to be looking at. By the time they bring it to you, it's a little too late to react to those changes. Now let me make sure. Okay, I feel like Jeff Watson and Mary Hart. I have my disclaimer, and I'm not gonna read it all to you, but understand, I do syndicate deals, I do offer securities, and this is not a solicitation to invest with me. In fact, anything I tell you today, I want you to commit to me with a raise of hands. I will not go out and do something just because Anna says I should. I'm gonna talk to my financial advisor and my CPA and my attorney. And it's hard to find one that understands real estate really well. So you need a team of advisors that's gonna help you and lead you correctly. Okay, about me. Jim gave me a wonderful introduction. Thank you so much. I hope I can live up to it in this presentation. But I am a full-time real estate investor. I syndicate apartment buildings. I'm a real estate consultant and coach, and an author and a speaker. I was not a natural speaker. I still get nervous. I was talking to Chuck, who said he was a nervous speaker. And I'm like, Chuck, you blew me away. I don't want to follow you. Like, who can rap like that? I'm 50 and I can't rap like that. But I do it because I'm passionate about helping educate other people. The most important job I have is I'm a mom of 4. My oldest is 21, about to graduate college, and he's what got me into real estate. So before I started in real estate, I was a private banker at Bank of America. So I got my securities license and was trained to handle the wealth of the top 10% of our banking clients in Houston, Texas. And from there I left and I went to work for AIG, also in Houston, Texas. And we handled insurance products that were private placement investments, where very wealthy individuals, banks, and institutions came to us with private investments that they wanted to put in an insurance policy so they could grow their investment tax-free, similar to what you do in a Roth IRA. So I had a lot of information and a lot of knowledge about securities and about investment and about wealth, but I didn't have any of my own money. I had a good income, but I really didn't have assets. And I realized that when I was pregnant with my first child, I couldn't be home with him, because I made about 3 times what my husband did just coming out of chiropractic college, and we had a lot of debt. We made the same mistakes that most people do. We rushed into the big house, had 2 new car payments, and a school loan that was bigger than our mortgage. So when I had my first baby, I couldn't quit my job. And as motivated and driven as I am, when I held that baby in my arms, I said, I just want to be home. That's all I cared about. I wanted to be able to take care of myself because I grew up in poverty and I worked really, really hard to climb the corporate ladder. But I wanted to be home with that baby. So we flipped our first house when he was 3 months old. We failed at it, but we learned a lot of lessons. My husband said, we're never doing that again. And I said, great, then you start your own company and you start making money as a chiropractor, and then I'll quit my job. So we moved to Pennsylvania from Houston in 2007 to start a chiropractic business at what we thought was the height of the economy. And everyone told us, business consultants, financial advisors, the economy is amazing. It's just gonna keep going. This is a great time to start a business. Well, that was in 2007. We all know what happened in 2008. And I took a big step back and we moved into a little 4-unit apartment building. I had flipped a house. We had had a couple of tenants in Texas. We bought a building that was a commercial building with apartments on top for him to practice in, and we bought a little 4-unit, and we moved in it with a 10-month-old baby and a 3-year-old baby, and said, how hard can it be, to have tenants? We'll do this on the side, and then if your business fails, then I've at least got enough money. Our living expenses are covered. Well, about a year in, my husband made a whole bunch of money, and I was like, yes, one more year and I can be home with these babies, and that's all I cared about. So I kept buying little 4-unit apartment buildings with every penny that we had extra. And suddenly, in 2009, which was really a year after recession had started, but it hadn't been declared a recession, AIG almost went under, Bear Stearns, Lehman Brothers, real estate investors, lost everything, hard money lenders went under, flippers went under. And I stood in my kitchen crying and saying, God, we've done so much to do the right things financially, and yet it's all gone. My 401k, about 2/3 of it was wiped out, and it was never coming back. And it was at that time that I had this aha moment that I worked for AIG with a lot of really smart investment people, and they were blindsided, and I was blindsided. The only thing that was going well, my husband's business slowed down. People didn't want to see a chiropractor because they couldn't afford it, so they popped pills. People didn't, I couldn't make money at AIG. They kept saying, you're gonna be laid off. Y'all need to look for other jobs. The only thing going well was my tenants were still paying rent. They didn't want to move out. We had great schools. We had low crime. We had lots of jobs. And I had this aha moment that I can never depend on a big company, again, for my financial stability. I can never depend on a small business, but real estate was really the thing that was gonna get me to protect my income, allow me to be home with my kids. And it was that moment that I realized, as smart as I thought I was, I was like 28 years old, had done pretty well, I really was pretty dumb when it came to the economy. So I share this with you to let you know these cycles repeat. And where we're living today, I would argue, is on a contraction that's not yet at the bottom, and the bottom is still to come. And I'm going to show you why I believe that. But it's really important. Had I known and understood the signs, I wouldn't have started a business with $700,000 in debt in 2007. We were not just poor with no money, we were negative $700,000 net worth when the sky fell out and the ground fell out below us. And I want to keep y'all from that happening to you, because wealth can be gone in a heartbeat when economic conditions give us something that we don't expect. So that's why this is important. All this other stuff, by the grace of God, truly, because I didn't understand it, but I knew when everybody's running away, I had learned from Warren Buffett in the investing world, be greedy when everyone's fearful, and be fearful when everybody's greedy. At the top, everyone's greedy. You should be afraid, right? The bottom's gonna fall out eventually. At the bottom, you're afraid, but you gotta choose. In Texas, we say, stop wallowing in it, get up, put on your big girl panties, get on the horse and ride. And that's what my stepmom said to me when I called her crying, what are we gonna do? Like, okay, I don't know what to do, but I gotta do something. I can't rely on someone to come save me. I've gotta save myself. And really, it's by the grace of God that I just made one good decision and the next good decision until it worked out. It took me 10 years. Also, by the grace of God, I never got laid off at AIG because our department was too complicated to sell. We did investments in Bermuda and other countries, and no company could buy us and go through the compliance. So I retired from AIG, I gave my notice in 2018, and I retired in May of 2019, so almost 6 years ago, and I retired a multimillionaire. I never dreamed that I would retire a multimillionaire. I never dreamed that I would make 10 times my 6-figure income in a couple of years by just doing deals and doing deals and doing deals until I figured it out. We lived check to check to check that whole 10 years. Every single penny we made, we put into buying the next rental property and the next rental property. The bank said no. I learned about creative financing. I started doing seller finance deals from retiring landlords. This stuff really does work. That, Bill was just talking about. And I didn't even look at my net worth. I didn't have to deal with banks and create a financial statement because I was going to sellers and I was just like, I just need $1,000 more a month. That 4-unit will get me $1,000, this 4-unit will get me $1,000, and I just kept buying properties until I had enough to cover our expenses and to cover our health insurance and a vacation every year. And then I walked away. I should have walked away sooner, but I was scared because I had lived through the GFC. Okay, so enough about me. Now, after I retired, because I'm a consummate entrepreneur, once I finally was able to retire, all 4 of my children were in school. So then I said, well, what am I going to do now? I didn't have the blessing of being home with them, but I knew it wasn't for naught. I knew there was something that I was still supposed to do. So I decided to start teaching other people. So I started coaching and teaching investors how to create wealth and income through real estate. And then I started joint venturing apartments. At that point that I retired, I had 100 units. So I had 100 units in 10 years. Seemed like decades, but I was able to retire at 44 instead of 65, and that's a blessing and the blessing of real estate. And why I'm so passionate about it, because it's changed my life, and I've seen it change so many people's lives as well. Now I actively own a portfolio of about $300 million in Texas, Pennsylvania, Florida, North Carolina, Tennessee, and Maryland, and I'm really passionate about helping others to do the same. So why do you need to become a student of the economy? These are really important. If you really want to become limitless and create wealth and income that allows you to choose whether or not you work another day in your life, you have to be a lifelong learner. You have to learn the fundamentals of anything you're doing, including the fundamentals of the economy, and watch signals and be prepared to react and adapt. You can know and be really excellent at what you do and still lose everything if you do not see when the economy shifts. Again, I've seen economic shifts during the GFC. The economy shifted again during COVID after I bought my first 2 large apartment buildings, and I figured out people don't have to actually pay, but I still have to pay my mortgage. It was quite a shock. And things have changed again in the post-COVID stimulus. After the government gave people and businesses tons and tons and tons of money, it created inflation, and we've been living through that the last couple of years. And it's starting to come down, but we're not at the bottom of the pain. And so this last couple of years, since 2020, has been the hardest couple of years for me as a real estate investor who bought my first property in 1998, flipped my first one in 2023, started rentals in, 2003, started rentals in 2003. It's hard. Real estate investing is not easy, or everybody would do it. But the key is, when these things happen and it seems hard, you don't want to wish that it was easier. You want to wish that you were better, and you want to get better, and you want to be in rooms like this with people that can give you ideas to say, how can I? I'm not going to be the one that says it's too hard, I can't find deals. How can you find deals? How can you do deals differently? I like what Bill said. How can you create a deal? How can you become a deal maker? They don't just always fall from the sky. They might after a recession, but they don't usually. The other thing is financing. This is really important. Financing is just as important as the deal, if not more important than the deal. And it can make you or break you, because as economies shift, they significantly impact banks and lenders, your bankability, the loan to value that you can get on a property, the interest rates, and that impacts your cash flow and the value of your properties. Loans can be called due. Lines of credit can be called due, and in a recession, they will be. Refinancing may be really difficult. I own several very large multifamily properties that we cannot refinance right now because values on paper have fallen 30 to 40%. Cash flow is great, but when you have a loan that only gives you 5 years of a lock and then you've got to have your rate adjust, it can be really difficult. Just as an example, we were able to buy properties a couple years ago, 80% LTV. To refi today, we're being offered 55% of a lower LTV. It's really difficult, and it's why so many people are giving the keys back to the bank. You might have to prepare for a cash-in refinance. Some of my properties are going to reset at rates, like Jim just said, from 3.75 or 4 to 7, 7.25 if things don't change. That's going to cut into our income unless I pay down those mortgages and cash in order to refinance. So I sold a bunch of properties in the last couple of years in order to have cash so that I could afford a cash-in refi. These are the kind of examples of when I'm saying you've got to watch the signs and prepare. I'm super conservative. I may look back and say, man, I shouldn't have sold those properties and held the cash, but I'd rather be prepared not to lose what I've worked so hard for than to say I kept a property that I was able to take a bunch of equity out. The other thing is you might be leaving money on the table. If you are not maximizing your returns by looking at your portfolio every single year and looking at the economy and where it's going, you might not know when it's a good time to sell. When are we probably near the peak? When might values fall? There are certain economic conditions that make multifamily or commercial a better asset class to hold in terms of its ability to force appreciation. There's other times when short-term rentals do really, really well, like post-COVID. Now, short-term rentals are not doing as well as people are starting to struggle and pulling back. I actually bought my first single-family house in, I think, 10 years, again, instead of another commercial property, because I was able to structure a deal really creatively and make a really good return. The other thing is if your equity is trapped because you wait too long to sell it or pull and cash out refi, you might not be able to refi and tap that equity when rates fall or when rates go up or when values fall. So it's important to always be looking at the economy, always look at your portfolio every single year and say, am I maximizing my equity? Am I maximizing my returns? And then the other thing is, again, you can lose money, but even more importantly, if you work with investors, you can lose investor money. There is nothing I can imagine worse than losing investor money. And let me tell you, I've got a lot of investors, and we have properties that are struggling. Even watching and even understanding these things, you can't always predict how long can inflation stay high? How long will the Fed keep rates high? How long will it take for cap rates to adjust and values to go up? So it's really important that you're able to identify all the risks of investing, despite however low you think the probability is, and to take actions, like Mary Hart said yesterday, to mitigate those risks just in case. You have a plan on paper. If rates go up, this is what I will do. If values go down, this is what I will do. If our taxes and insurance go up, this is what I will do. If we get sued by a tenant that slips on the ice, this is what I will do. If the economy shifts, this is what I will do. You need to think through it all, and so you need to constantly be learning to identify risk and then determining, like Mary said, am I going to off-source the risk? Am I going to mitigate the risk? Am I going to transfer it? Am I going to not do the deal? And there's a lot of deals that I've looked at the last couple of years that I've chosen not to do because the reward and the returns were not high enough for the risks that I was going to have to mitigate. So the higher the economic uncertainty, especially when these shifts happen, the more is outside of your control. Don't do deals assuming the best case scenario. You want to do deals assuming the worst case scenario, and then everything else is gravy on top. So this is why I want you to tune in to the rest of this presentation. I'm going to give you a ton of data. It's important to understand each of the metrics, but more importantly, I want you to understand the high level and how to see these things shifting so that you can start preparing not only to mitigate risks of what's coming, but to create tremendous, limitless opportunities when these shifts happen. So the first thing I'm going to talk to you about is just understanding economic cycles. And I'd encourage all of you to take a picture of this if it's something that's new to you. But economies go in cycles that ebb and flow. They go up and they come down, and they go up and they come down. And it generally happens every 15 to 18 years, somewhere like that with real estate. But a peak is when the real GDP, gross domestic product, or sales and income of the country peak, with the maximum output and unemployment, high employment, and confidence is really high, business confidence, consumer confidence. You have rising inflation, profits get stretched as consumers have to pull back because the cost of living has gone up. Rates get raised by the Federal Reserve to slow growth in the economy, to keep it from overheating and inflation getting too high. Some sectors start to contract, and depending on where rates are, credit and inflation can be either short-lived or long-lived, being loose or tight. Then you move into a contraction when things start to come down. real GDP decreases, the economy slows, consumers pull back, profits start to decline, investment slows because interest rates are still high and it's hard to find deals that work with really high interest rates. Layoffs begin as profit targets start being missed. Confidence then starts to decline. Does this sound familiar? Okay. Rates are held flat or high until inflation is killed and it goes starts coming below target. And then eventually the Fed cuts rates to prevent a recession. They try to pull off, the proverbial soft landing. Usually they mess up. Usually they're too late, and that could cause a deeper and greater recession if they're too early or they're too late. Credit starts to tighten, and this is really important. You might have a great relationship with your banks like I did, but once the economy starts to really contract and they have other customers that are defaulting, it doesn't matter that you have a six-figure job and an 800 credit score and other real estate, because as I'll show you later, real estate usually leads into a recession. It usually goes into recession first. How many of you know that real estate is in a recession? Transactions are at a 30-year low. That's a sign that it's leading into a contraction and a recession for the rest of the economy eventually. But banks start to tighten. I got told no by my banks that said yes, and I only had one bank that said yes for a while. Then I had a second one, and both of them during the GFC laughed in my face. You work for AIG, you have $700,000. My husband had $700,000 of business startup debt, and you want to buy real estate, which is crashing all over the world. They thought I was ridiculously stupid, right? And I was not a good credit risk to them. Thankfully, I don't take no for an answer, and I keep going till I find a bank. But it is an important time to understand that if things are contracting, you better be developing really good relationships with really good lenders. People like Wendy Sweet and Mary Hart, I know Jim and Tom Olson. You want to find non-bank lenders and start those relationships and start doing deals with them now before you get to the bottom. So what happens at a recession? Recession, it's a scary word, but it just means you're at the bottom of the economy, the slowest growth period. Real GDP declines to the lowest level. Unemployment then starts to really tick up. There's low investment because people are afraid and they run away and banks won't finance them. Bankruptcies and foreclosures uptick, and there's very low confidence in the economy and people, your renters, your employers. And then what happens? The Fed drops rates extremely low, like they did in 2008, like they did after 2000 and COVID. And they do that to get you to become more confident and speed up the economy again, to go back and invest, for businesses to invest in employment and in future profitability for the country, for investors to go out and invest. A lot of people borrow to invest in the stock market, leveraged investing, so they will drop rates really, really low. Fiscal and monetary policy both get really loose to fuel a recovery. Fiscal policy is the government giving you money, helicopter money, in certain sectors of the economy that they feel they need to spark up. Monetary policy is the Fed's rates and easing and loosening of money. Bank credit gets the tightest after a recession. This is something that's really important in timing. You will not be told we're in a recession until 8 to 18 months after it's already started. So you've got to know what the signs really are. But the banks are watching, and generally it takes them about 6 months to get to panic mode, where they dry up their credit and they lower your LTVs, they drastically lower credit, they tighten credit quality, so they'll require higher credit scores, they'll require a higher debt coverage ratio, meaning your income has to cover the debt by a larger amount than before. And the depth of a recession, the time that it lasts, and the diffusion, or how broad across the economy it is, varies with every single recession. No recession is exactly like the other. But what you need to remember, is when everybody's running away, when everybody says you are crazy, you're going to lose everything, we're in a recession, tenants aren't paying, real estate values are going to crash, what does that mean to you? It's the maximum point of opportunity. It is your once in an 18-year on average opportunity to go buy as much as you possibly can, lock in low-rate debts for mortgage rates as long as you possibly can, because when things start to recover, interest rates will rise again, right? Values will rise again. So you have to remember, when everybody is afraid, when you're afraid of what the news is saying, when you're afraid of what I'm going to tell you, because we're going into a recession, if you walk out of this saying, Anna Kelley said it's a recession, I'm not going to buy, you have missed the boat. Anna Kelley says it's a recession, it means it's going to get scary in the economy, which means you have the maximum opportunity to be a problem solver. Help people that are in pain. Do it with integrity. One of the reasons I agree to speak for Jim is because this group of people here are teaching you how to do it the right way, with integrity, and being good to people. I never want to make money off of taking advantage of people, but I am going to make money taking advantage of opportunities that present themselves by doing it and doing well by people. You do well by doing good, and God will bless you for that. During the recovery and expansion, after the government lowers rates and gives out money, real GDP will start growing, employment starts to rise again, businesses start to invest, profits start going up, consumers start spending, confidence starts growing. An average recession lasts 10 months, average. An average recovery is 2 to 3 years. So we are not yet technically in a recession, okay? I would argue that we are in very recessionary conditions, which I'll show you. But the key is, it might be another 2 years before we have a full recovery at best. So you're going to have a couple-year opportunity where you can go buy a lot of property at really great rates. You may or may not get great deals. You may not find properties that are really cheap by comparison, especially in a weird economy like we have today. But you can create great returns through creative financing and through structuring a deal in a way that is going to let you pay whatever price the seller needs and still maximize your returns. So it's several years from a recovery until a true expansion. And we've been in the longest expansion period since Abraham Lincoln was president. Now, I'm old, my kids say, because I just turned 50 last year, but I wasn't around when Abraham Lincoln was president, and I was a little baby during the 70s and 80s when we had something similar today. But what happens is these expansions can take 10 years, 12 years, 13 years. You feel like a rock star. Everybody's a rock star in real estate. I realized that even though I did a lot of things and created a lot of success by running into the fire during the recession, it was by the grace of God and the fact that we had an expansion that I was able to build tremendous wealth over that next 10 years in that expansion period. Thankfully, now I understand that, but you see a lot of people that do really great in any kind of business and any kind of real estate during an expansion, and then you've got to be prepared for it to contract. So these things are going to happen in cycles, and the better you get at seeing it, the better you will be as a real estate investor. The more income you can create, the more wealth and equity growth you can create, and the better you can protect what you've worked so hard to build. The other thing to understand here is that real estate cycles, there's two different kind of cycles that people will talk about when they say, where is the economy heading? And if you don't know what they're talking about and what indicators they're using to say where the economy's heading, you can make some mistakes and your timing is going to be really off. So there's cyclical trends, and these are these little red lines in this first chart that go up and down and up and down and up and down. And you can have a trend that says in the next 6 to 18 months, it seems like we're heading toward a contraction or an expansion. And then there's secular trends, which are longer term. What's going to happen in the next 3 to 5 years or longer? I can tell you that the U.S. as a whole have been on a downward secular trend for a long time. Our growth, which used to be sparked by manufacturing and production in the 70s, with the baby boomers, so many people spending and paying taxes and producing growth, that has been on a 40-year decline. The growth that we produce as a company is coming down as a secular trend, and that means that growth in the future is more likely to be slower than it has been in the past, which means you have to work a little bit harder to create growth in the future than you potentially did in the past. So cyclically, these changes can go in short terms, up and down, without ever hitting a peak and without ever hitting a trough. Economists, depending on who they are, and analysts are looking at different things to tell you whether we are heading in a contraction or not. You could be at a peak and still see that long-term we're going downward in terms of growth, but that doesn't mean panic, it's time for a recession. You've got to see what they're looking at. So the key indicators, I want y'all to take a picture of this slide. I think it will help you to just have as kind of a cliff note version, are either longer leading indicators, shorter leading indicators, or coincident real-time indicators. If you look at this second chart on the top, you'll see 3 different lines that are going up, and then they come down at different times. The first line are the long leading indicators. These are the things that well in advance of a peak or a trough recession will start to turn upward or start to turn downward first. When you see those things, it's a sign that probably in the next 10 months to a year, maybe 18 months, we're going to start seeing some changes in the cycle. And again, if an expansion lasts 10 years, you're not going to see this every year. You're not going to see it in 3 years and 5 years. You're going to have to remember to watch the signs over time. Okay, so longer leading indicators are things like monetary policy. What is the Fed doing, not what are they saying? The Fed and the government want you to think the economy is healthy and stable, because if you don't, you'll stop spending and they'll put you into a recession. So they're going to lie to you. That's the truth. They're going to lie to you. The economy is healthy when the economy isn't. If the Fed raises rates, it's because they see inflation's going to be a problem. They can say inflation is transitory. We're not going to raise rates. But when they do raise rates, it tells you inflation is coming. You better prepare. Your rates are going to go up. When they start cutting rates, they can say the economy is stable. Employment is stable. But if they're cutting, it's because they're trying to prevent it from becoming too unstable too quickly, and they're trying to prevent a deep, quick recession. So watch what the Fed is doing, not what the Fed is saying, and you'll have an idea well in advance to prepare yourself for these shifts. The other really big one, it has 100% predictability accuracy, is the yield curve inversion. I'm going to talk to you about this in a few minutes, but generally, we are paid more to hold money in a bond, a U.S. Treasury, if we hold it for 10 years than we do if we hold it for 2. Why would I want to lock my money up for 10 if I'm not making more money on that than I would if I lock it up for 2? When that inverts and people demand higher rates for a 2-year Treasury than they do for a 10, it's the bond market, the smart money, saying, uh-oh, we think there's a risk of recession, and therefore the yield curve inverts. When it uninverts and goes back to normal, it's usually right after that that the recession comes very, very quickly. So you've got to watch the 10-year and the 2-year Treasury and see what they're doing along with monetary policy. And then you watch what happens in housing, because housing goes first into contraction, and housing leads us first out of a contraction. Remember that. We're all real estate investors. How many of you know, okay, residential real estate, was it in a contraction? Not values. Transactions, okay? We are in a transaction recession. Commercial real estate, any of you invest in commercial like I do? It's our GFC. Values are down 30%, transactions are down 80 to 85%, 90% in some areas. It's leading us in early. The shorter leading indicators, the things that start to happen before a recession, usually 6 months to a year before, are labor. So when the news says labor's great, employment's great, the economy is healthy, well, it doesn't really get bad until real time. But if labor starts to soften and you start to see layoffs like we're seeing, then it's a sign that a recession is most likely on the horizon. Manufacturing, trucking. Manufacturing is technically in a recession, and it has been for almost 2 years with little blips coming back, but it's shifting back into recession already this year. That's telling you that things are in a contraction and heading toward a bottom. Then you finally get to coincident real-time indicators. What's happening today? This is most of what you hear on the news, the real-time indicators. The National Bureau of Economic Research, the NBER, looks at these numbers to say, are we currently in a contraction? And then they tell you, again, 8 to 18 months later. These are employment, payroll, retail sales, industrial production, and personal consumption. When we are finally in a recession, everybody will already feel it. Everybody already feels it, but it hasn't come through to all those indicators yet. But if you understand that these things go in paths, it's very, very, very rare to have a contraction that doesn't follow through to become a recession and then just bounces right back into a recovery. And so these are numbers to watch. Other numbers to watch that are real time are GDP, the growth level and how it's produced in the country, CPI or inflation, and then employment last. Other things that can change and make a recession happen faster or slower, or a recovery happen faster or slower, are what's happening with US Treasury rates, because that drives our 30-year fixed mortgages. What happens to our currency value versus other countries? Are we having trade deficits? Are we having trade wars? It's interesting, about a year ago, I thought, well, at least we aren't at a trade war, because those things can spark hot wars as well, and it's something we need to watch and be prepared for. But those things are now happening, right? So we want to look at debt to GDP, the nation's debt, and whether the country can afford to spend the money to get us out of a recession once we're in one. And I would argue that this time, our country cannot afford to spend a whole lot of money and give us a lot of helicopter money like they did in 2008 and in 2020, because our debt is too high and rates are too high and the government cannot afford the interest on our debt. You have to watch fiscal policy. How much is Congress saying they're going to spend? Is the debt going to grow or is it going to pull back? Are they going to cut spending or are they going to raise spending? All of those things will stimulate or be a pull on growth and could make you faster or slower inside and outside the next cycle. Okay, I've got to go a lot faster here. So I'm just going to touch on these. Feel free to take pictures. I think the presentations are going to be available from Jim. But here are the main numbers to look at. Consumer spending, unemployment, wage growth, and real GDP. Those are real time. So this is the stuff that you hear every day on the news, but it's like too late to the party. You need to be watching the long leading indicators and the short leading indicators before these coincident indicators. I'm going to talk to you about the HOPE framework for watching, because it's a lot easier to understand than all these other numbers, and then the money supply. So where are consumers? Hopefully y'all can take a picture of all of those. I'm just going to touch on a few. But the reality is this is going to affect your buyers, this is going to affect your sellers, this is going to affect your tenants, it's going to affect your employers. 68% or so, it varies a little bit, of growth in the economy, GDP, is sparked by consumer spending. So if you have a healthy consumer, which we've all heard on the news, we either hear, depending on who you watch, everything's great, or everything's horrible. And the reality is kind of somewhere in between. But the reality is 66% of US households today are struggling. About 50% have less than $500 saved. 59% of households have less than $1,000 saved. If you're a landlord and your tenant can't pay rent, this is why. The vast majority, especially those that are not higher income, are struggling. The savings rate is down nationally to 3.8% per household. The average is 8.7. From 1959 to 2024, people have held 8.7% in savings of some sort. The high was 32% in 2020. That shows you that the government basically gave people about 24% of all the savings that they had through the helicopter money, which is why we have inflation. The low was in 2005, just before the GFC. Credit and auto defaults are all rising, evictions are rising, and now people have to pay back their school loans that they thought for perpetuity they wouldn't have to pay. So we are seeing a huge decrease in credit quality in applicants, and it doesn't even report the negative school loans yet. That has just started as of March 1st. There are huge wealth and income gaps, and so even though we have a positive GDP, 90% are pulling back. It's the top 10% that is floating our spending. In fact, as of last month, 10% of the income, the top 10% of income earners are actually spending 50% of all the spending that's creating growth in the economy. Low income and young were spending a whole lot, and now they're pulling back. They just can't anymore. So the question is, in addition to that, consumer confidence is now at the lowest since August of 2021, and as of earlier this week, I saw that it actually is now lower than 2020 during COVID. So as consumers are rocked, they can't afford anymore, they can't spend anymore, growth will start to slow. Unemployment and wages. There's something to watch called the SOM rule. The SOM rule is the rate of growth of change of employment. Even though 4%, you'll hear that's great unemployment. It's a low unemployment historically. It's the rate of change that really impacts the economy. And we have been in recessionary employment conditions since February of 24. It kind of bounced back, and then August of 24, depending on these two rules, SOM or McKelvey. But what it's saying is that job growth is actually worse than what it looks like in real time. Unemployment is rising. Jobs were overstated, this is important, in December of 2023 by 818,000. There were actually no net full-time jobs created in 2023, no net full-time jobs created in 2024. There were positive government spending and positive healthcare spending. In fact, in 2024, 25% of the new jobs created were government jobs. Historically, when the government is creating 10% or more of the jobs, it leads to recession. It's telling you you're in recession in the private sector. The government's now going to spend money in the public sector in order to keep GDP just barely going. The FOMC projects that unemployment will rise to 4.4% now and stay at 4.3%, so a little higher than today, through 2026 and 2027. Real wage growth is actually up only 1%, and this is another leading indicator. Before companies lay off, what do? They quit giving you raises. That happened to us at AIG before the crash. It should have been like, here's your sign, but I didn't know. And then they reduce hours. So instead of letting you work 40 hours a week, we only need you 35. So right now, employers have reduced the average full-time hours from 40 to 35. It's the precursor to the layoffs that generally come. DOGE is expected to cut 100 to 200,000 full-time jobs, and the contracts that they're cutting is expected to cut about 450,000 contractor jobs. So this, again, is just another sign of what's to come. GDP components. GDP is in a slump. We're not necessarily recessionary, but what's really important to understand is that the government spent 7% of our GDP to produce a 3% GDP. If they had to spend 7% to get 3%, it tells you that the private sector, everything that isn't government, is actually in decline. And I'm going to run through the rest of these numbers fairly quickly. Inflation. So regardless of what they tell you, where I would recommend you go to see real inflation that's higher or lower than the government number is a website called trueflation.com. They take a basket of hundreds and hundreds of goods that people are really spending money on that don't exclude food and energy and gas and all of those things. But Trueflation says our inflation is actually down today as of early this week to 1.78% annualized growth, which is down 0.5% since February. Goods inflation is actually almost non-existent now. The growth is 0.84 per year, services is 2.3. Inflation is clearly trending back down toward the 2% target, which is why the Fed is saying we're planning on cutting rates 50 basis points this year. However, inflation fears by the sparking of tariffs is what's got the stock market and the bond market absolutely going nuts. It's Jekyll and Hyde. One day it's up, one day it's down. Will tariffs manifest and create inflation, or is it just Trump being pushy to try to get these countries to drop their reciprocal rates so that tariffs actually get lower for the United States? We don't know, and you're going to see a lot of volatility with inflation, with rates, with 30-year fixed mortgages as well for a little bit. Okay, so where are we in the economic cycle? The headline numbers, these coincident indicators, show that private sector has basically been in recession, okay? But we're not there at an aggregate level. In 2022, we had 2 quarters of negative GDP. We had recessionary leading indicators, but the NBER did not declare a recession because it didn't flow through to the aggregate total numbers. We have recessionary unemployment. Government spending propped up GDP. Private sector growth was actually negative. We talked about the bifurcated economy, but what is clear is that we are on a contracting path, growth is slowing, and consumers are pulling back. In fact, the first government official that actually admitted we are in a private sector recession is our new Secretary of Treasury, Scott Bessent. He says we are in a private sector recession and the economy is brittle. Concentration in less productive areas healthcare, government spending is what's producing growth, and that's going to be a drag on growth as the government starts cutting spending and consumers pull back. So that's your key leading economic indicator. If you go to the conference board, the FOMC conference board, and the NBER, they will actually show you where are the leading economic indicators today. It's an aggregate of all those 10 leading economic indicators that say, what is the country doing? What is the economy doing? Where is it heading? And what you'll see is that they go down just before a recession, and then they come back up when the recession is over. And the little red lines in the middle of a gray are prior recessions. And what you'll see is post-COVID, starting in about early 2022, we actually had all the leading economic indicator aggregate fall to recessionary levels that gave the government the signal, we're in recession. Wasn't called. Came back up. They got a little bit better with all the government spending that stimulated the economy, but they've teetered recessionary since. And as of February of 2025, they've hit that warning line again. Warning, recession's here, recession's coming, and this is a government website that they're tracking. So while they're saying the economy is healthy, we've had 2 years of the leading economic indicators telling the government, recession, recession, recession. So the conference board has actually said, they publish monthly reports. I encourage you to go to their website and watch it. Overall, the index points to a fragile, if even not recessionary, condition and outlook for the U.S. economy. That was April of 2024. In January, the LEIs indicated a more negative consumer sentiment, fewer hours worked, and they fell again in February, pointing to headwinds ahead. So weakness triggered that warning signal, and that should be a sign for you that more contraction is coming. You can also see the period of time between when leading economic indicators normally go negative and when they actually hit a recession. Generally, once they turn negative, a recession is 6 to 8 months out. When you see that red line, 6 to 8 months out, you're in a recession. Right now, it's been 25 months that we've been in that red line recession without a recession called. But what you'll notice is it's very, very, very rare for those indicators to go down without a recession before they come back up. Okay, yield curve, we talked about. Money supply, I'm going to save if you want to take a screenshot of this. Essentially, the amount of money in the system drives growth and inflation, or it pulls back. You can see the last big spike was the post-COVID money. It rose about 25%, and now we're in negative territory. The last times that money supply were negative led to the Great Depression, the 1937 recession, 1948 recession. Our money supply was the highest ever post-COVID, and now it's contracted, and it's been the most contracted for 30 full months at this point. So we talked about the Treasury. The Treasury market, again, the yield curve inverted. So this slide is showing you that in 2023, people demanded higher rates for a 2-year Treasury than a 10-year Treasury. When the Fed cut rates in September, Treasury rates actually went up because the bond market said, okay, the Fed is going to cut rates into weakness, but we're worried more about inflation. We think that they've made a mistake, and because they're worried about inflation, rates went up. Well, now what's happened, and as of March, Treasury rates have fallen again. It's because the Treasury market, the bond market, even though they're worried about tariffs and inflation, it remains to be seen what that will do. They're now more worried about a recession, which is why they're demanding lower rates, because the Treasury market demands higher rates when we think we're going to have growth and inflation. So this is important. I do expect, don't look at it every day and say it's up, so now there's inflation, and it's down, and now there's a recession. I expect a lot of volatility until it becomes very clear that we are in a recession. Okay, this is just another indicator showing you that the leading economic indicators in blue start to turn negative well before the coincident indicators that are in black. And what you can see is since 2022, our leading economic indicators on the blue line are just sharply down, yet the coincident real-time growth has just continued to be okay, grow a little bit, but it's very abnormal that this is what's happened. And it's because we spent so much money in government spending to keep those numbers going. But this is the longest period of time that we have seen between the time that the economy started showing us we're heading into recession and when the recession's actually declared. So again, we are in contracting conditions. We have been for 2 years. but suddenly it seems like consumers and businesses are starting to freak out a little bit. You're starting to see profits being missed in the stock market. You're starting to see this treasury rate coming down, and that's telling you that we're on a contracting path that is most likely going to lead to a formal recession. So this is another important slide for all of you real estate investors. Generally speaking, real estate follows economic business cycles with some lead time before you start to see the rest of the economy change. Where you are in the cycle impacts supply and demand for properties, ease and flexibility of credit, the best strategies for profitability, whether you do value add deals or whether you buy and hold, for example. And these cycles generally last about 18 years between peaks and valleys of real estate. The expansion of 1990 to 2005 took 15 years. The peak in 2016 before the GFC, or 2006, I'm sorry, the peak in 2022. Again, this is when everybody was greedy, and we should have been a little fearful and start to pull back a little bit or do things differently. The last bottom was 2009. Will the bottom be this year? Maybe. If so, it's been about 16 years, so we're kind of on target. But it's important to understand that during a recession, demand for properties plummets. Default rises, foreclosures start to soar. It's a great time for you then to go buy properties, usually for rock bottom prices. The bad news this time is what usually happens right before a recession is there's hypersupply. There's too much housing, and that hypersupply is what creates too much housing for people to rent or to buy, and it's what leads you to a recession. But this time, because of the artificially low interest rates, about 85% of households locked in their mortgages at really low historic rates, anywhere from 2.5% to 5% interest. So they don't want to sell their house. So you don't see the hypersupply of housing. You don't see the values cratering as a result. Your mileage will vary, and every market's going to be different. Some markets, like I have 2 oceanfront properties in Florida, there are 4 condos in my building that people are trying to sell just like mine, and they're dropping the price. I don't care because I don't have to sell it. I have a really low interest rate and it cash flows, but people are panicked, and there's certain markets like that where taxes and insurance have gone up, where there's a ton of supply. Those are markets for you to go look in for really great deals, low price properties, knowing that the values will eventually rebound. So in hypersupply, it's time to sell your properties. It means we're at a peak. I might have sold some properties early, and in hindsight, I kicked myself. Like, I never thought it would keep going for another year, and I sold too early. But I'd rather be a little bit early than to be caught and not be able to sell my properties by waiting till too late. In a recovery, it's a great time to buy properties because rates are still extremely low and values are just starting to slowly come out. So it's a great time to buy properties, to refinance. When rates fall, refinance everything you possibly can and buy everything you possibly can in any way that you can, in any niche, whether it be single or multi or short-term rentals. You're going to have a little bit of high vacancy as people struggle to come back around, but it is a great time to buy property because you're going to hold them through the next expansion. And again, that usually lasts about 10 years. So if you plan to buy properties and hold them for 10 years, you'll likely be able to sell them near the top. So the goal is buy low, sell high, and if you can't do that, then get creative with your financing. I don't have a whole lot of time left, so I'm going to go through this quickly, but I encourage y'all to look up something called the HOPE framework by Michael Kantrowitz. And what he does is he shows you how recessions start. There's an order. Housing goes in recession, then manufacturing orders decline, then profits are missed in the stock market, then and only then do you have the recession, and then and only then does employment go high, unemployment rises, and that's what we haven't seen yet, but it doesn't mean we're not on the trajectory, okay? Again, where are we in the cycle? I would argue we are in a contraction, late in the contraction, in a private sector recession, and we're not yet at the bottom, but the bottom is likely not too far away. It's very difficult to time the economy. I've gotten it wrong. I've sold too soon. I've started a business at the wrong time, but we can start to see these signs and understand where things are headed. The biggest thing is you want to have multiple exit strategies. You don't want to be flipping houses and flipping apartment buildings when you're heading into a contraction, because the likelihood is the values are going to continue to fall. They might not, and every market's a little bit different depending on your supply and demand, but during the growth phases, when the expansion phases, when you can bank on appreciation and cash flow growing. In the contraction phase, those short-term investment options become a little bit more risky than buying something and holding it for the long time. The last thing I want to say on the recession, historically, when you have a recession, U.S. Treasury rates fall because the demand for a return falls. But right now, the government debt is so high, and it's pretty insurmountable, that the Treasury market, even if we have a recession and the Fed cuts interest rates, it very likely could be that the bond market demands higher interest rates for the risk that the U.S. can't get out of our debt and that we have a debt spiral or go into hypersupply. That is the fear. If that happens, you might have rock bottom prices but have high interest rates. The bottom line is, don't wait for rates to do what you want them to do, thinking that you have to wait, it's not the perfect time. Do a great deal at all times. You can make money in any economic cycle. You just got to make sure that it makes sense for your goals. At all times, your financial goals should be one of three things: more income, growth of your wealth or equity, or asset preservation. When you are coming down from the peak and heading toward the bottom, no matter where you are, preserve what you have first. Preserve what you have first. Second, you will choose whether you're looking for growth or for income, and you only do deals that are going to give you that. If you need income, don't go buy an oceanfront property for a high price and hope it's going to go up in value when you're heading toward a recession. It's going to fall for a few years. If you want growth, go buy a really cheap oceanfront property. You have enough income, you can float the cost for a few years while you wait for it to grow up, but you have to know your goals and where things are going. Jim, can I have 2 more minutes? Okay, awesome. So there are some changes that are happening under Trump. One of the things that could really shift how quick or how long a recession might be and a recovery is the new major change in fiscal policy. So the goal of the current administration is to stimulate productivity. When governments get so much debt to GDP compared to historic numbers, they really only have a few options to get out of the debt. One is they try to create a productivity miracle. If I can get the country growing again, then we can collect more tax dollars to pay down that debt. So their target is to get AI companies and tech companies and manufacturing companies to come to America, and we're starting to see some of that success, but it takes a really long time. Art Lafler, who was an advisor to President Reagan, who helped him spark a productivity miracle after the inflation of the 70s, thinks that we can potentially hit that 3% growth next year. Others say that it's going to take several years. The next thing that governments do is they have to cut programs. This is why DOGE is going fast and furious to cut expenses. Their goal is to cut government spending by 15% and deficit spending being no more than 3% of GDP. But the key is government debt is going to continue to grow. They just want to keep it no more than 3%. The other thing is they usually have to raise taxes to pay for the debt. Republicans tend to take the opposite approach. They want us to have lower taxes so we're not cutting into what's already high cost of living, and they want to stimulate companies and investors to stimulate the economy by giving us tax breaks that'll hopefully trickle down. The next thing is tariffs. Trump's tariffs could create some more inflation, at least in the short term. But his goal is to bully the other countries to get them to drop their tariffs so that everybody has low tariffs, which can actually stimulate more growth. And the other thing is to get energy costs down. They want to produce 3 billion barrels a day by 2028. So their goal is to make a recession. It's not to avoid a recession. I think they know that we're basically already in one. It's to get us out of it more quickly. So watching what happens there is important. I want to tell you one more thing, and I want y'all to just take pictures of these slides because I'm not going to hit every one of them. But it is important to understand that different economic cycles give you different, better opportunities, truly limitless opportunities if you're looking for the right thing. In inflationary cycles, which we are in, I think we will have our recession, and then the amount of government debt tells us that the government is probably going to create inflation to make their debt cheaper to pay off with in future dollars. They've done it for 40 years plus, and they'll continue to do it again. So don't think that because we have a recession, inflation's off the table. I believe we're going to have stagflation. We're basically in a stagflation-like environment where we have high prices and low growth. it's very, very difficult for governments to get you out of that. Generally, when there's inflation, you have high rates and low fiscal spending. Average returns during inflation are actually pretty good. Look at what your stock market's done during inflation if you have money. Stocks have gone up about 10%, bonds have gone down about 5%, commodities have been okay to good. Metals actually do really well in inflation. But real estate in inflationary cycles, your rents and your values rise unless you're in commercial real estate where the values are dependent on interest rates, not like residential. So during periods of inflation, commercial is not the place to be. During periods of inflation, residential is the place to be. You want to buy properties in really every cycle, but especially during inflation and recession, that are in low expense, low tax, conservative areas. I don't care if you're liberal or conservative, but you better invest in conservative areas that are landlord friendly, that are investor friendly, and that are going to try to keep your taxes low. And you want to invest in areas with low crime, great schools, and good jobs. If you only remember one thing, it always works. No matter where you are in the cycle, invest in areas with low crime, good schools, good jobs, because people will prioritize rent and they will pay. During inflationary cycles, you can try to invest for cash flow and for preservation, but you can't bank on appreciation once you've had a peak, because you're going to have 2 to 3 years of generally falling values before they come back up. So don't buy anything that you're not going to plan to hold for a really long time. This is why flipping becomes kind of dangerous starting with inflation and through a recession compared to buy and hold. During recessionary cycles, values tend to fall when people can't afford a place to rent, but rental income is usually really good if you're in those stable areas. You want to buy cheap from motivated sellers and distressed sellers. Who are the motivated and distressed sellers today? Commercial real estate investors that are forced to sell because they can't refinance their debt, right? If you got a huge risk tolerance and a whole lot of money, you might take some risk and make a lot of money when things correct. Vacation rental owners in oversaturated areas like the coast of Florida, like parts of Tennessee. I own properties there. I bought knowing we're going to have a peak, things are going to slow down, but I don't care because I locked in 30-year fixed mortgages at 4%. I knew I was beating inflation, and I have the wherewithal and the cash to be able to float those costs even if my rental income goes down. So I bought really cheap vacation rentals. They are motivated sellers for you to go after today. And if you can structure subject to and do it the right way, talk to Jeff Watson, make sure you're doing it the right and ethical way, that could be a great opportunity. And also construction builders of single-family homes who have overbuilt and can't sell them. KB Homes had 68% of homes go into cancellation last year. So there are a lot of single-family homes. I actually was able to buy my mom a home in San Antonio, Texas from a home builder that overbuilt 1,000 homes. I got it $40,000 off the sales price and was able to get her into that. So that's a really good thing to consider, as well as Section 8 housing, because the government always pays. Okay? Wartime. I hate to even talk about this, but the reality is we're in a very scary world. China wants Taiwan. Iran wants Israel. Russia is in Ukraine. During wartime, it's really important to understand what does well and what doesn't. It brings inflation. It brings higher rates. So watch for what's happening. Real estate does generally well during war. So why do I love rentals? I have 300 rentals in my backyard that we live on. I'll never sell them. Somebody challenged me last night, you're going to get tired and sell them. No, I make it passive. I have full-time people running the day-to-day, and I just look over the numbers, right? I might sell at one point, but I can rest easy at night because I have a portfolio that constantly provides me income whether I buy another property or not. I'm a big believer in buying rental property. The other thing is when you have inflation, your values generally over time will continue to go up if you own residential housing because people always need a place to live. The only other thing that kind of does really well during all these periods is gold and silver, and I've bought a lot of gold and silver in the last couple of years as well. But be very careful investing in military cities like Kelley, Texas. I have lots of coaching students who wanted to buy in Kelley. I'm like, do not touch it with a 10-foot pole, because if we have war, your tenants are all going to be deployed, and they don't have to pay you rent. They can break their leases. So it's really important to know that. Stagflation, this is the last one, is my base case for what's coming longer term. Buy and hold property, lock in low interest rates, be cautious on flipping and value add, and again, invest in the same kind of areas. The last thing I want to share, and y'all can take a picture of this, is biblical wisdom for all times. I have learned that in good times and bad, I can only make the best decisions that I know how to make. With my own wisdom, with my advisors, with my friends, don't be afraid to ask questions. The Bible said there's wisdom in a multitude of counselors, and I made a lot of mistakes because I didn't seek counsel. But one thing that I know is the Bible, and I believe this holds true and is truth, is that as for the rich in this present age, charge them not to be haughty. Do not set our hopes on the uncertainty of riches, but on God, who richly provides everything for us to enjoy. I pray for wisdom in every single deal I do. And I want to share this because Jim asked me to, and I shared it with him. I lost a lot of money in a Ponzi scheme last year, and it did shake my confidence. Like, how could I do this? I've been investing and reading PPMs for like 28 years at this point, and I lost money in a Ponzi scheme. And I realized, like, what could I have done different? Because even though I didn't create the fraud that took my money, I invested in it. And I realized, I told Jim the other day, every deal that I do, I pray, because I'm a go-getter, and I'm going to make it happen. And I will beat down the door, kick down the door, dig under the door, climb over the door, catch it on fire, whatever I need when I have a door that I want to go through. I say, how can I do it? So I pray, Lord, protect me, give me wisdom. If this is not a good deal that's going to bring you glory and bless my family, don't let me do it. Don't let me get it done. And if it is, swing open the door and let me walk through it. And the Ponzi deal I didn't pray about. I needed a tax deduction. It was the end of the year. It was somebody I trusted. They had done the deals for several years, and I lost money. So if I leave you with one thing today, watch the signs, understand what's happening, get better, continue to educate yourself on the economy, but pray for wisdom, seek other counselors. And if you are doing things the right way to honor God and doing it with integrity, you're going to make mistakes. You could lose a lot of money, but God is very faithful to continue to bless you. So.
Oh.
Sorry, I went a little over. Thanks. You're so welcome. You're so welcome.
Oh, yeah.
Oh,
Can you?
okay.
Can you have a seat?
Okay.
Oh, my gosh. What do you guys think of that? Did you get a lot out of that? Wow. Woo, Maria.
Up enough?
Yeah? There's Gavin. Gavin, wave your hand. You've been with me since Dealmaker number 1. Jane, too. Where did Jane go? All right. Thank you, too. All right. Come on up. Really quick. Yeah, get everybody up here for this, and I'm going to take care of this while you're doing it. Is that okay? I'm going to talk really quick. How many of you guys are in Dealmaker discounts? We got a lot of opportunity here. I'm telling you what, you guys are leaving money on the table, both with Lowe's and Sherwin-Williams, where I am negotiating hard with Floor & Decor. Chandler, they are very difficult, aren't they? They emailed me again last night. But we've had a great partnership with Sherwin-Williams. I'm telling you personally, I mean, you know my account. My paint went down $10 a gallon, which was 25%, when I signed myself up for my own Dealmaker discount. I have a really good friend of mine who's also a real estate investor part-time, but full-time as a painting business. Every Sunday when I see him at church, Roy tells me, thank you. And his wife is so thankful. Can you talk about how it works with Sherwin-Williams really quick?
So we have a national agreement with Dealmakers. You get the set wholesale pricing, but it takes off, like he said, about 25% off each gallon.
I'd like to say 25%.
Doesn't hurt. Whether it's you or if you use subcontractors, whoever it might be, they can use that account. We do offer financing options, but it's a national agreement that you guys are going to save a lot of money. We keep all your records, all your purchases, break it up by different properties, different sites, whatever you guys want to do. We're here to help, and all your stores are connected. So no matter here, Oklahoma, Washington State, your account goes with you everywhere you go. So.
I mean, you all should be saving. We negotiated this nationwide because Dealmaker expanded a year ago to all these cities. And because of that, it gave us the ability to go out and negotiate with people like Sherwin-Williams. And they are awesome to work with. Many of you have a form on your table. Fill that out, and during lunch, put it on the Sherwin-Williams table, and we'll get your account set up, and you will start saving that 25% on paint right away. So I just want to say thanks for being here this week. And hopefully you get a whole bunch of these. If you don't have one, see Melanie at the table. Jeffrey Taylor in the back, nice to see you, my friend. Can't wait for this afternoon. We're going to have lunch at 12:15, and we're going to be back. We're done with lunch at 1 o'clock, Rita, so it's all good. Rita's watching my schedule. This is one of my favorite panels. It's called the $1 billion panel, billion with a B. The reason we started this a year ago is because there's a lot of capital raisers and deal makers every single time. Who here would like to learn something about raising capital? Because real estate is capital intensive, right? I have raised a lot of money. I'm a private lender, but I'm also a borrower of many millions of dollars. I play both sides of that table. So does my entire family, and it works really well for us. Some of these guys are hard money lenders, at least the first 4, 5 out of 6, 7 out of 9. And I'm telling you what, hard money lenders know how to raise capital into a fund. So just real quick, tell us who you are, what you do, and that sort of thing. Randy, you go first. Turn it up, you're good.
Randy Shelley out of Chattanooga, Tennessee. We got a hard money lending business there. We got 13 million on the street. Well, just about to cross 13 million on the street here, and done a ton of apartments and self-storage also in and around Chattanooga and Alabama.
So not only is he a lender, but he's a borrower. Did you catch that? 13 million is a lot on the street. Bill?
My name is Bill Phillips. I'm from southeastern Virginia, Carrollton, Virginia. I own 608B Capital, which is a hard money lending fund. We're nearing $10 million in funds. And we also actively invest mostly in like the Hampton Roads area. Yeah.
Excellent. Miss Wendy Sweet, my bud,
Yes.
take it away.
So I love the name of your company. It sounds like an address.
It was mine and my partner's college address, 608B Clement Street in Radford, Virginia. Yep.
Wendy Sweet, Carolina Capital Management. We have 2 funds. We lend all over the Southeast. I've been lending since 2002.
Woo! You're way too young to be lending that long.
I know.
Tom?
Tom Berry, Houston, Texas. We lend about 30 states. We have several funds, and we've got about 177 million on the street.
Did you say 170? How do you sleep at night with that much debt?
Chump change.
177. He sleeps good, doesn't he? Tom's also our auctioneer this afternoon. Round of applause. Thank you. All right, Isabel.
I'm Isabel Garino. I teach real estate investors how to own and operate residential assisted living homes for seniors.
Do you teach them how to raise capital?
How to raise capital for those deals as well, exactly.
Do you have a little tip on your mind, on the tip of your tongue?
A tip for raising capital
Yeah.
for this? You know what, it's a whole, let me ask this. Raise your hand if you're getting older or know someone who is. This is something that's going to impact us all, so it's kind of one of the easiest things to raise capital for because everyone will be impacted one way or another.
All right. Adam?
I'm Adam Burrow with Conduit Capital and Tom Olson out of Northwest Indiana, and we're a hard money lending fund that works with real estate investors who are flipping houses or growing their rental portfolios.
Well, and Adam, I'm going to help you out a little because you also have a debt fund open right now that's returning 12%, which is really high, but it's closing soon.
That's right, yeah, looking to close it soon and start up another fund, so definitely looking for some the last few investors to round us off before the next offering. So.
All righty. Anna Kelley. Wasn't Anna amazing? Oh my gosh. What a deal maker gift.
Thank you so much. It's my pleasure. Anna Kelley, my company Greater Purpose Capital raises money for commercial deals. Right now, I'm not actively raising money because I don't feel like the deals give good enough returns for the risk that are there. But when I do have something, if you're looking for something, you can find me there.
Jeff?
Jeff Shahosky, Best REI Funding. I don't even know what we have on the street now, 40, 45 million.
Oh my goodness, I
something
didn't
like
know it was that high.
Yeah, it's been growing crazy. I'll be completely transparent. About 3 weeks ago, I picked up $1.5 million in 1 week.
Wow.
Because one of my competitors decided to poo-poo all of their private capital. And so since they decided to do that, we've just heavily targeted. I say that not to brag to you guys, but to point out that stuff happens to not just us and what we're looking for, but it happens to other people around us, and there's opportunities that are created by it.
Love it. So who's got a question on raising capital? Who's trying to raise some capital for something you want to buy? This takes a lot of money to do real estate, right? Whether it's a... Oh, Martine. Okay. I'm coming to you, Martine. Here we go.
Hello, everyone. What is the best way to get someone interested in lending with you? Not to you, but with you.
Ask.
But like,
What should you say if you want a co-lender? I mean, Wendy, all of you guys also sell your loans after you originate. Is that correct? No? Tom, you do not? You keep them all in-house? Randy, you too? Wendy, you sell?
We sell.
Bill, how about you?
We keep all of ours in-house.
Okay. All right.
I keep all mine in-house too.
Okay, Wendy, you're the only one.
I sell my notes. We sell all of
Hypothecate?
our money because we want to recapitalize our fund. I got $22 million in one fund, but I have $40 million on the street because
Oh,
we
is that
resell our
possible?
notes. It is possible. So you can double what you're doing by selling the notes.
So Martine, I do a lot of lending and I work with co-lenders on wraps. I love the returns on wraps. And for me, I've found my co-lenders by just telling my story and letting people know that when I have a new opportunity, somebody can come in and work with me. I've done this with Dee. Where are you, Dee? You're over here today.
I have a question for Martine.
So-
why do you want someone to lend with you
Oh, that's
rather
a good
than
follow-up
to you?
question. All right, good question.
What are you thinking?
well, I'm already really good at getting people to lend to me. I want people to lend with me so I can do more loans. If I lend by myself, I only can do a finite amount. I want more so I can do more
So
loans.
you're looking for a co-lender?
Yes,
So
correct.
you can wrap loans?
Correct.
Gotcha.
Yeah. So what I do, Martine, is I tell people that I have an opportunity. And when I have a new opportunity, oftentimes, you guys are in my Facebook group, I'll just put into my Facebook group a post saying, I'm working on this new loan, and I'm looking for a co-lender if anyone's interested. Chuck has found people like his dentist just by telling the story that when somebody says, what do you do? Chuck, where are you? And
He's getting a new lender.
okay. He'll say like, I have a lending business, and every once in a while I'll have an opportunity to have somebody come into the deal with me. If you have any interest, let me know. Al, you know I'm coming to see you. You do a lot of this, so how have you found your wrap lenders?
Honestly, it's really just talking to people and having a personal connection with them, because if they trust you, then they're willing to allow you to perform with the loan.
Well, yes, stand up with us, Al. You've been a Dealmaker regular for a long time. How many of you guys know Al? Yeah, good guy right here. So that's a good question. Who else has the next question? Okay, oh, here we go. All right, I'm coming to you. Oh, thank you, David. You've always got my back.
Good morning. I have a question. Rural properties, I know that some of you don't like to touch them. Under what circumstances might you be open to them?
Yeah.
I can take
Tom?
that. Sometimes we'll do a rural property, but we'll just lower the LTV, right?
There you go.
So rural
Mitigate the
property
risk.
has more risk to it because there's not as many buyers for that property should that deal go bad. So we're going to look at how can we reduce that risk, that additional risk you bring with the rural property. And one of the easiest ways to reduce risk from our standpoint is just lowering the LTV, or you bring in a little more cash to the deal. All of a sudden now you've brought more risk, but you've taken it away with pulling another lever. Does that make sense?
Yes.
Who in our group today would like to buy something bigger, like you're thinking a little bit bigger? It's just commas, zeros, and dollar signs, but you're nervous about being able to pull it off. and you got to raise that capital either in a fund or some other way. Jerry, did you have your hand up? Okay, here you go.
Yeah, I'm moving in, and I'm moving into commercial. I know you don't like that space right now, but there are a lot of opportunities.
Oh, I like it.
Okay.
I like it.
Okay, and I can find the deals.
You gotta get a better return than the risk on the deal. That's the key.
Yeah, yeah. But I guess it's for everyone. My very first self-storage, I had no knowledge of that space. So I brought in a seasoned investor who, I put up half the money, he put up half the money, and I gave him half the deal. And it was my deal that I found. But I wanted his experience in that space, which is why I'm going to be talking with Tom a lot over the next year. Tom Barry is going to be hearing from me a lot over the next year, because I want that knowledge. I'm willing to give up huge amounts, put up my share of the funding, but learn. You're willing to take that, huh? Yeah, he likes that. But when you do go into those bigger spaces, the zeros, I'm an ender. The zeros kind of scare me. They don't scare my daughter and son as much, okay, but the zeros scare me a little bit more, which is why we reach out to the knowledgeable. And I guess that's the lesson, is find people, lenders that are knowledgeable in that space. Am I correct in looking at it that way?
Would you advise somebody who's looking to raise capital for the first time in like 7 or 8 figures to cut somebody in with some equity to help you?
I want to field one thing there. There is going to be a zero that's going to scare everybody. You just keep adding zero, and I don't care if you're a billionaire, I don't care if you're a millionaire, it doesn't really matter. There's going to be a zero that scares everybody. Some people are going to be more comfortable with more zeros. I have found, though, when you can mitigate your risk and you can get okay with some of those zeros, and you can have at least a good plan to learn to find, or at least have someone to go to that you know that could come up with that capital. You know, kind of speaking even towards Martine's, you can, so many times in my whole career, I had no way to fund the deal. But I remember my first commercial deal. We had it was a $450,000 purchase. I had no way to close it when I got into it. But I knew it was a dang good deal. Well, I figured it out. And it's amazing how money is attracted to good deals. So for you, Martine, if you find the deals, a lot of times the money will come. You just freaking pick up your phone and call everybody on this panel, call everybody you know. And another thing you're going to learn from that is what is a good deal and what is not a good deal, because it's going to be really easy to fund a really good deal.
Can I add something to that?
Yeah, boy, there was a lot in that. Do you guys feel it? Go ahead, Anna.
One thing about really bigger zeros, and when I started syndicating, I was a little afraid, but at that point I had already had 100 units. So I'm like, I already know how to operate 100 units. It's just one property of 100 units instead of a whole bunch of them. But in the commercial space, generally, you've got to have somebody that has operations experience. You got to have somebody to find the properties, somebody to fund the equity piece, and then a great lender. Lenders are starting to really back off of lending to new commercial investors unless you have a lot of experience in real estate in general and you have a partner that's operated multifamily. So I started to learn where I wanted a bigger piece of the pie when I first started to syndicate, because I had the experience and I found the deal, but I had to find the partners who were willing to give me the money. So there's always operators looking for great equity partners, and there's always great equity partners who are looking for great operators. So I would say don't go it alone and don't get the biggest property you can first. You know, a lot of multifamily seminars teach bigger's easier, bigger's better, and the reality is bigger does have more risk. And when things like this GFC for commercial happen, a lot of great people lost a lot of investor money because they hadn't lived through this time period. It hadn't happened in 40-something years. And so to continue to be bankable for the best long-term or long amortized loans in commercial, you need a partnership team that together collectively has skin in the game, enough equity and reserves set aside in case something does go wrong, somebody that has that operations piece, and collectively your total net worth and the GP and the total cash reserves that you have and the total number of years experience is going to make you really easily bankable as you stack that partnership with the right team member. So it's really more team investing instead of, you know, one partner. Now, my first one, I was very blessed. I found a deal and I knew how to operate, and I said, I'm going to syndicate this. And the first investor I went to had just gotten tens of millions of dollars of selling a business, and he said, I want to be your only partner. And so my experience, my net worth, and his liquidity is what allowed us to get like the Fannie and Freddie loans for 30-year amortization. So your team is key.
There was a lot in that one. Did you guys catch it?
Yep. Going back to Martine, I'm going to do you a big favor right now.
Here we go, Martine.
How many people in this room have a self-directed IRA? Every one of you raise your hands high. You see that? There's all your money right there.
It's here. Tell your story, Martine.
You're welcome.
There's two sides of investing that not a lot of people talk about. The one side is acquiring it, and that is valuable. Acquiring a good investment property or acquiring a good loan on a good LTV. The other side is the management side. And the management side is where a lot of people screw up. And your deal is only as good. You can buy the best deal in the world. We bought some awesome apartment buildings, and kind of Anna talked towards this. You know, and those last ones we bought, they kind of suck. Like, even though we bought them right, it's mainly because it was out of town. The management is the key to anything. So money is always looking for really good operators and managers.
Ooh, powerful. Who's got one more question? We got time for one or two more questions, I think. Right, Rita? Where'd Rita go? All right, where? Oh, right here. Here we go. Here you go, Austin. How you doing, Sharon?
He's going to be on the hot seat tomorrow.
Thanks. I have no idea if I'm even asking the right question, but I'm looking online here at a convenience store gas station. Like Tom had mentioned, something sort of recession-proof. And it says 6.5% cap rate, but it offers things in the description like 9% rental increases, you know, significant tax benefits, accelerated depreciation. Like, how do I get better and quicker at analyzing how to quantify that, like, back to someone, and just cut down the time it takes to kind of analyze that?
How do you get better at quickly doing the napkin math to know whether it's worth looking at closer? Tom, can you take that one quick? Somebody? I think you're doing a lot of them.
Yeah, first of all, I'm not doing gas stations, but
why not? Why not?
Well, there's other considerations. Environmental Protection Agency is one of them. And I wouldn't look at anything that's trading at a 6 cap when interest rates are 7.5 or 8.
There you go.
I'm looking for a delta of 250 to 300 basis points between my cap rate and the long-term interest rate that I can lock in. If I've got 250 to 300 basis points spread, I don't care what the economy is doing, I'm going to make money, right? But right now, you got stuff trading at a 6 cap, and that's great for somebody that has all cash, and all they want is a 6% coupon, because that's really what they're buying. But that's not me. I want to lever it, and I can't get 6% money or 4% money to get my delta, so that would not work for me.
So quick look at the cap.
Oh yeah, and just to add to that real quick, there's a difference between moving quickly and cutting corners, and I think when you're looking at deals, the more deals you vet and work through, the faster you're going to get at your process. So it's important to create a due diligence process that yields the results that you want. What you don't want to happen is you want to move really quickly to do the deal, and leaving something in the dust, forgetting something when you're evaluating that.
That's really,
Bill?
really good. One thing on cap rates, this is kind of a quick and dirty way to evaluate something. If you go out and you just Google risk return chart, like on a financial advisor site, it's going to start with the U.S. Treasury rate, the 10-year U.S. Treasury, as the risk-free rate of return. So whatever that Treasury rate is, that's considered risk-free. Today, that's at like 4.3%, something like that. For example, then it goes up to government bonds are a little more risky, you need better returns, then BBB business bonds, and then Class A multifamily. Historically, Class A multifamily has traded at 130 bips, so 1.3% above the 10-year Treasury. That's for brand new Class A, no problems, no headaches. Then as you go to B class, you add 1%. As you go to C class, you add 1%. And you'll see, I don't know where gas stations are on that chart, but you'll see the stock market, you need a higher return because it's more risk than real estate. Gas stations are probably more risky because of economic volatility with gas prices. But once you find that risk reward chart, you can look at what's the historical spread of the cap rate over the 10-year U.S. Treasury. And if you start there, that's the minimum return you should demand if you paid all cash for the deal. Then you can spike that return by using leverage. But that's a quick and dirty way to evaluate it.
Yeah, and so I'll add to that, just based on the question of the gas station, is your buy box and niching down to specifically what it is you're trying to buy. If you're looking at every, storage unit deal that comes along, every gas station, every business, it's impossible because they're all a little bit different when you're underwriting them. We set up our lending business around single family flips because we niched down a long time ago and started flipping houses, right? We can walk through deals in, 5 minutes. Multifamily properties, we niched down there and we, bought multifamily deals, but it's very easy to get scattered around and look at everything that comes your way, and then you're not good at any of it, right? To niche down, know exactly what you're trying to buy.
I'm going to simplify it, because your original question is, how do I get faster at it? To me, there's only one path. It's repetition. Just look what the pros do in anything. I don't care if we're talking about sports pros or business pros. The only way that we get better is repetition. You have to sit down and just go through deals. One of the things that I've advised people to do, it's like, if you're trying to analyze deals and get experience with it, and you also want to talk to, say, the sellers, pick a market that you know you would never buy in. Pick deals that you wouldn't want to buy, unless it was so insanely good that you couldn't help yourself, right? Because if you call these people in these weird, strange markets that you're never going to buy in, and the conversation doesn't go well, what's the harm, right? It's a great way to figure it out, but you got to do the reps to get there.
And I'm just going to say, I think there's some other solutions potentially. Couldn't you create a GPT to help you, Anthony? Absolutely. Is that what you're thinking right now?
Well, actually, what I was just thinking about, I kind of go to AI on pretty much, on everything now. Right. No, I appreciate that. But with that being said, as long as you have an understanding of what the end result that you're looking for, right? Now we have technology to help you get there so much faster and help bridge the gap, right? And so,
there's a need for that.
And there is.
Want to partner up? Would you guys want that?
One thing that I didn't bring up too is financing. Your underlying financing is going to depend on what you can pay. That's what Tom got to. That's what multiple people, Anna got to. So right now, 2 years ago, all the financing costs went up. So therefore, cap rates on property have to go up. So what does that mean on commercial when rents don't go up? The purchase price is going to go down essentially for that cap rate to go up. So if you're using debt, and debt can be a great thing, because it can increase your return on investment, but debt can also be a very bad thing without reserves and to have at least good cash flow in that, because it can turn real quick.
Sandy?
I have not asked ChatGPT this, but you guys are the pros. So there is a huge need in the United States and worldwide for housing for people on the autism spectrum that are high functioning, but they want to live individually. So I do have like a vision of having villages, small villages, and is it such a thing for like people with money to get behind a mission? Like how do you do this? How do you get the money for something like that?
Okay. I'd like to hear Jeff Chahosky on this first.
So as someone on the spectrum, which is why Jim picked me first.
I'm sorry, and a heart for mission.
Yeah, you have to find people who share that mission and that belief and that value structure and that want to help people in whatever class that we're talking about, whether they're on the spectrum or they have some other handicap or disability. You just have to find people that believe the same as you. One of the most powerful things about this community, it's the reason that I fell in love with it, it's the reason that the vast majority of the people who keep coming back all fell in love with it, is because we all share common visions, goals, and dreams here, right? You just, when you niche down into a specific thing, you just have to niche down into people that have those same things. But you need to find the community that believes in it.
Yeah.
Rita.
I would say we teach on senior housing and residential assisted living, but we get a lot of people who come to our training who are interested in housing for developmentally disabled adults, battered women, sober, shared housing, all sorts of type of group housing, because no one else is showing anyone how to do it. So through the research over the years, what we've found, because I've spent a lot of time going down that path, because I want to give people an answer who are coming, even though it's not exactly the same, is typically the ones that are successful, they're being run as nonprofits, and someone is out there leading the head. They are raising capital, they are out there continuously doing that. It's a little bit less, like with senior housing, we can get private capital all day. But with those housing, typically they're usually most successful as nonprofits.
Did that help, Sandy? Wow. Raise your hand, Sandy. Okay. Did you guys enjoy the $1 billion panel? It's one of my favorites. You guys are rock stars. And man, if there's time tomorrow morning, I'm going to fit another one in because I have more questions. But thank you guys from the bottom of my heart. You're all so good at raising capital, utilizing capital without getting over leveraged and creating great returns. So thanks for pouring into the Dealmaker community today. Thank you guys very much. Okay, Rita,
Yes, thank you. We have like 2 second
You wanted
thing,
me-
and then we're done. I
Okay.
promise, we're going to lunch. Okay, real quick,